Welcome to this Academy introduction to stock options. We'll be looking at what stock options are, their main benefits, and how they can be used in your trading practices. Stock options are financial instruments that stock investors can use in a wide variety of ways. Traders can choose to purchase an option on a stock instead of the stock itself. They can also buy options in order to protect a stock position. The common stock that is used as the basis for the option is referred to as the underlying asset. The two types of option contracts are known as calls and puts. As a buyer of a call option, you have the right to purchase a stock at a specific price, which is called the strike price, by a specific deadline, which is called expiration. As a buyer of a put option, you have the right to sell a stock to someone else at the fixed price by the expiration date. Simply defined, a stock option is a contract between a buyer and a seller, where the buyer has the right to buy a stock and the seller has the obligation to sell that stock. Consider the following example. A car insurance policy is a contract between a driver and an insurance company. The driver, in other words, the buyer of the insurance policy, has the right to coverage in the case of an accident. Meanwhile, the insurance company, the seller of the policy, has the obligation to cover any damages as a result of the car accident. So what are the advantages of trading stock options? As we mentioned earlier, the buyer of a call option has the right to purchase the underlying stock in the future and may be able to purchase it at a lower price than the market rate at that time. Traders can also benefit from large moves in the market, whether those are upwards moves or downwards moves. Finally, traders can receive income by selling an option for a premium against stocks that they own. Most option contracts are bought and sold in the open market, and they control 100 shares of the common stock. The instruments are listed and traded on exchanges, such as the Chicago Board Options Exchange, Eurex, and others. A special organisation called a clearinghouse issues and guarantees the clearing and settlement of options. So let's take a look at trading options. When you purchase an option, you're the owner of that contract. You're therefore said to be long. Being long simply means that you own something. When you sell an option, however, it means that you're short or you don't own that contract. When a trader sells an option, they'll receive money from the buyer, which is known as the premium. The terms long and short are widely used by traders in markets such as stocks, commodities, futures, foreign exchange, and even bonds. We'll discuss long and short strategies in greater depth further on in the training. Now consider the following example. You believe that the shares of Chinese auction site Alibaba will continue to rise, and you want to capitalise on this. Let's explore how an option purchase may be different from a stock purchase. Instead of investing over $11,000 to own 100 shares, you buy a January call option with a strike price of $110. This will allow you to exercise or purchase the shares at any time on or before the third Friday in January. For this call option, the purchase price is quoted at 7.50 points. To calculate the actual price, however, you simply multiply the points by $100 to get the total investment for the contract, which in this case is $750. If Alibaba shares appreciate to $120 by the expiry date, you will have the right to buy them at $110. If you'd purchased the shares, you'd have a profit of $1,000 or 9%. But suppose you'd bought a call option instead. The call option may have appreciated by $500. This would be a smaller capital return than you would get if you'd bought the shares, but it represents a substantial percentage gain of 66% on your initial investment of $750. The higher percentage return is due to the leverage that options provide. Let's walk through another trading example. Suppose that you also have a bullish market outlook on Apple shares, but you believe that the stock has moved too high too quickly. You decide to sell put options on Apple shares. This means that you will collect a premium from selling the option and assume an obligation to purchase the shares from someone else at a later date. Now let's say that the price of the underlying Apple stock is currently $119 per share. You sell a put option contract with a December expiry date, committing to buying the shares at a cost of $116 each when the option expires. For this you receive a premium of $133 per contract from the buyer of your put option. Now there are two possible outcomes to this strategy. Firstly, if the stock closes below the strike price of $116 on the day that the put option contract expires, you would be obliged to purchase the Apple shares at a price of $116. On the other hand, if the shares trade above $116 on the day that the contract expires, you will get to keep the full premium that the buyer paid you for the option, and you will not be obliged to buy the Apple shares. Many investors generate regular monthly income streams from selling put options. Now let's take a look at option exercise and assignment. The two styles of options are known as American style and European style. The difference between the two styles lies in how these are exercised. American style options can be exercised at any time on or before the third Friday of the month of expiry. European style options can only be exercised on expiration day. Stock options are American style options. The buyer of an option has the right to exercise their option. As a buyer, you may choose to sell that option in the marketplace, exercise it, or do nothing. By contacting your broker, you can exercise your options and purchase the shares of a stock. The seller has no rights, but they have an obligation. If the seller holds a short option, they can be legally obliged to buy a stock from someone else or to sell their own stock. Lastly, let's take a look at leverage and risk. As we mentioned earlier, options allow you to trade with leverage. By paying $750 you can control an investment of $11,000. If the price of the underlying stock moves favourably, the leverage can magnify the gains that you make. But if the stock moves against you, the leverage could very quickly amplify your losses. Although most option strategies have limited risk, some, like short calls, may have unlimited risk. Let's summarise the basic concepts of stock options. Options are legally binding agreements or contracts. An option contract is an agreement between two parties to buy or sell stock at a specific price during a fixed period. The right to exercise an option contract belongs to the buyer, while the seller has an obligation to either buy or sell stock if the option is exercised. Options offer investors a variety of strategies to protect their assets, generate income, and speculate according to the market outlook. With options, investors may need to take their time to explore one or two strategies that best fit with their goals.